Everyone keeps repeating this 8-4-3 rule like it's the secret to getting rich. But what if I told you it's actually holding you back? Seriously, this rule sounds smart, it feels safe, and on paper, it looks like the perfect formula for building wealth through compounding. That's why so many people trusted it for years. But here's the truth no one wants to admit. The environment that made the 8-4-3 rule work, it's gone. We're in a completely different game now. Interest rates aren't the same. Markets don't behave the same. Inflation is playing by new rules. And the way people earn, invest, and spend money has fundamentally changed. So, if you've been following this rule in 2026, and your portfolio isn't growing the way you expected, you're not the problem. The strategy is outdated. In this video, I'm going to break down exactly why the 8-4-3 rule is failing today. And more importantly, I'll show you a smarter framework, one that actually fits how money moves in today's economy. Stay with me, because by the end of this, the way you think about compounding is going to completely change. Let's break down this 8-4-3 rule everyone talks about. At its core, it splits your investing journey into 3 stages. Phase 1, the first 8 years. This is the quiet phase. You're investing consistently, but growth feels painfully slow, almost like nothing is happening. Then comes the next 4 years. Now things start picking up. Your returns begin stacking on top of each other. You finally feel some momentum. And then, the final 3 years. This is where the magic is supposed to happen. The curve goes vertical. Your money starts multiplying fast. Now to be clear, the math behind compounding is real. No argument there. Money does grow faster over time. But here's the real question. Does this neat, predictable 8-4-3 timeline actually survive in today's market? Because this entire model depends on a few big assumptions. It assumes you're getting steady, reliable returns, around 8% every year. It assumes you can invest consistently without interruptions. And it assumes the market behaves in a relatively smooth, predictable way. That might sound reasonable in theory, but in today's reality, those assumptions are falling apart. Let's zoom out for a second. Between 2022 and 2024, the S&P 500 didn't move in a clean, upward curve. It was chaotic. Sharp drops, sudden rallies, uncertainty everywhere. And that kind of volatility doesn't just slow down compounding. It disrupts the entire timeline. The 8-4-3 rule depends on. Now let's talk about what actually happened in the real world. Inflation surged to levels we hadn't seen in over 4 decades. The Federal Reserve responded by hiking interest rates aggressively, the fastest pace since the 1980s. And suddenly, even the safe side of your portfolio wasn't safe anymore. Bonds started losing value fast. At the same time, something even more important was happening behind the scenes. According to Dalbar's 2024 report, the average investor didn't come close to matching the market, while the S&P 500 delivered around 8% annually over time. The typical investor barely captured about half of that. That gap isn't random, it's behavior. And this is exactly where the 8-4-3 rule breaks down, because it doesn't teach you how to act when things get ugly. It just tells you to wait. But waiting, without a clear system, turns into hesitation. Hesitation turns into fear. And fear leads to one costly mistake: selling at the worst possible moment. So before I show you what actually works today, let's break this down clearly. Here are the 3 reasons this rule is failing people right now. Reason number 1. It ignores how markets actually move. The 8-4-3 rule was built during a very different time. Back in the 80s and 90s, markets were on a long, steady climb. It was one of the strongest bull runs in history. But since 2000, it's been a completely different story. You had the dot-com bubble, then the 2008 financial crisis, then the COVID-19 market crash, and most recently, the 2022 stock market downturn. 4 major disruptions. In just over 20 years. That's not a smooth curve, that's turbulence. And here's the problem. A simple 8-year foundation phase doesn't prepare you for what happens when a crash hits in year 6. Because when that happens, most people don't stay calm, they freeze, they doubt everything, and eventually, they pull out at exactly the wrong time. And when people pull out, they don't just lose money, they reset the entire clock. Years of progress, gone. And now they're starting from zero again. But here's the key point most people miss. That's not a discipline problem. It's a broken framework. Because the 8-4-3 rule gives you no real tools to handle volatility. It doesn't prepare you for chaos. It just says, trust the process. And in today's market, that's not enough. Reason number 2. It ignores where your money actually goes. The 8-4-3 rule is built around time, not strategy. It tells you when to invest, but says almost nothing about what to invest in. There's no real guidance on diversification, no structure for managing risk. And in 2026, that's a serious flaw, because markets move fast. One sector, like tech, can drop 30% in a matter of months. We've seen it happen inside the S&P 500 itself. If your entire portfolio is concentrated in one area, you're not investing, you're exposed. But the 8-4-3 model treats the market like it's one single thing. Put money in, wait. That's it. No allocation strategy, no protection layer, no adaptability. Reason number 3. It ignores one of the most powerful drivers of wealth, growth in your contributions. This is the quiet flaw almost nobody talks about. The 8-4-3 rule assumes you invest the same amount every single month for 15 years, flat contributions. But real life doesn't work like that. And more importantly, neither does optimal wealth building. Because when your income grows, even slightly, and your investments grow with it, the results are completely different. In fact, even small increases over time can dramatically outperform a flat contribution strategy. So, if your income is rising, but your investments stay the same, you're leaving serious money on the table. Now, here's something most people completely underestimate. A small change in behavior can create a massive difference in results. A study from Charles Schwab found that investors who increased their contributions by just 1% per year ended up with significantly more wealth over time compared to those who kept their investing flat. Just 1%. Now think about that for a second. What happens if you scale that to 3% or even 5% every year? That's not a small tweak. That's a completely different outcome. And yet, the 8-4-3 rule doesn't even acknowledge this. It assumes your financial life stays frozen, while the real world keeps moving. So at this point, you're probably thinking, if this rule is outdated, then what actually works? And this is where I want you to pay very close attention, because this next idea is the most important shift in this entire video. Before we build a better system, we need to keep what the 8-4-3 rule actually got right, because it did get one thing right, and it's too important to ignore. Compounding still wins. That hasn't changed. It won't change. Time is still your biggest advantage in the market. In fact, research from JP Morgan Asset Management shows something most investors don't realize. If you stayed fully invested in the S&P 500 over the past 20 years, but missed just a handful of the best days, your returns dropped dramatically. Miss the top 10 days, your gains get cut almost in half. Miss more than that, and your performance collapses even further. Why does that happen? Because the market's biggest upswings usually come right after the worst drops, which means the people who panic and sell during crashes, they're almost always the ones who miss the recovery. So the principle is still solid. Stay invested. Give your money time. Let compounding do its job. That part is not the problem. The problem is the system built around it. Because a flawed system is dangerous. It gives you confidence without preparation. It makes you feel like you're doing everything right until the market tests you. And when that moment comes, most people realize they were never ready. And here's the uncomfortable truth nobody talks about. Most people following the 8-4-3 rule don't even make it to the payoff phase. They quit early. Around year 4, maybe year 5, they've already invested thousands, but they're not seeing the explosive growth they were promised. So, they lose belief. They lose patience. And eventually, they stop. They open their account. And what they see doesn't match what they were promised. The growth feels slow. The numbers feel disappointing. And worst of all, they don't have a system that explains why. So what happens? They stop. Or even worse, they pull their money out and chase something that promises faster results. And that right there is the real danger of a weak framework. It's not just that it underperforms. It's that it pushes you out of the game entirely. Now, let's build something better. The framework I'm about to show you is called the 7-5-3-1 rule. 4 numbers. Each one fixes a major flaw in the old 8-4-3 model. And together, they create a system that actually works in today's market conditions. Let's start with the first number, 7. This is your minimum time commitment, not 8 years. 7 years. That might sound like a tiny change, but it completely shifts the odds in your favor. When analysts studied every rolling 7-year period in the history of the S&P 500, going all the way back to 1926, they found something powerful. Every single 7-year window delivered a positive average return. Not most, not usually. Every single time. Think about that. You could have started investing right before the Wall Street crash of 1929, right before the dot-com bubble, or right before the 2008 financial crisis. And if you stayed invested for 7 years, you still came out ahead. That's not luck. That's how long-term market cycles actually work. Now compare that to shorter time frames. Invest for just 1 year. You've got a decent chance of winning, but losses happen far more often. Stretch it to 5 years. Your odds improve. But at 7 years, that's where the game changes. That's where probability starts working for you, not against you. But this isn't just about math. It's also about psychology, because how you frame time determines how you behave. If your plan is built around 8 years, and you're sitting in year 5 with slow growth, your brain starts asking questions. Why isn't this working yet? Shouldn't I be seeing more by now? Doubt creeps in. Impatience builds. And that's when people make mistakes. But with a 7-year framework, year 5 doesn't feel like you're behind. It feels like you're 2 years away from the turning point. Same timeline. Completely different mindset. And that matters more than people realize. Because at the end of the day, the biggest threat to your portfolio isn't inflation. It's not interest rates. It's not even the market itself. It's your behavior. It's the choice you make in year 4. When your portfolio looks like it's going nowhere, and someone you know just made 40% overnight flipping some random crypto, that's the moment that defines everything. Not the market, not the strategy, your decision. That's why the first rule, 7 years, is non-negotiable. You don't try it. You commit to it. Write it down. Set it as a deadline. Treat it like a contract with yourself. Because without commitment, no strategy survives. Now, let's move to the second number. 5. 5 categories of diversification. This is where most people fail, and where the 8-4-3 rule completely falls apart. Because diversification isn't optional anymore. It's what keeps you steady when markets get unpredictable. Here are the 5 categories that build a resilient portfolio. First, broad market index funds. This is your foundation. Think funds that track the S&P 500 or the total US market. With one move, you're investing in hundreds, sometimes thousands, of companies. Historically, this layer has delivered strong long-term returns. This should be the largest portion of your portfolio. somewhere between 40% and 60%, depending on your risk tolerance. If everything else goes wrong, this is the part that keeps you anchored. Second, dividend-paying stocks or funds. This is your income engine. These aren't just assets that grow. They pay you consistently, even when prices are flat or markets are down. Dividends keep flowing. And when you reinvest those payouts, you're stacking compounding on top of compounding. According to Hartford Funds, a massive portion of long-term market returns has come from reinvested dividends. That's not a bonus feature. That's a core driver of wealth. Allocate around 15% to 25% here. Third, small and mid-cap growth stocks. This is your acceleration layer. These are smaller companies with higher growth potential. They're more volatile, no question, but they also offer the kind of upside that large established companies usually can't match anymore. This is where you capture asymmetric growth. Yes, small and mid-cap stocks are more volatile, no question, but over the long run, they've consistently outperformed larger companies. Historically, smaller companies have delivered higher average returns than large-cap stocks. And here's what most people miss: that small percentage difference. Over decades, it turns into a massive gap in wealth. Same starting money, completely different outcome. That's why this category exists, not for safety. For growth, allocate around 10% to 20% here. Less if you're closer to retirement, more if you have time on your side. Fourth, international funds. This is your hedge against being too dependent on one country. A lot of investors ignore this. They assume investing in US companies is enough. But here's the reality. The US doesn't represent the entire world. When you only invest domestically, you're leaving a huge portion of global opportunity untouched. And more importantly, different regions don't always move together. When the US market slows down, other economies can still be growing. That balance matters. It reduces risk. It smooths out your journey. Allocate around 10% to 20% here. Fifth, defensive assets. This is your protection layer. We're talking about bonds, treasury bills, or even cash reserves. These aren't designed to make you rich. They're designed to keep you stable. Because when markets crash, this is what stops you from making emotional decisions. For example, during major downturns, safer assets have historically held their value, or even gained, while stocks dropped hard. And that stability gives you something incredibly valuable: control. Because when part of your portfolio is holding steady, you're far less likely to panic and sell everything at the bottom, and avoiding that one mistake can make a bigger difference than picking the perfect stock. Allocation here depends on your stage of life. Younger investors, around 10%. Closer to retirement, 20% to 30%. So why does this 5-part structure matter so much? Because compounding only works if you stay invested, and you can only stay invested if your portfolio doesn't collapse during a bad year. Diversification isn't just about higher returns. It's about survival. It's about reducing the chances that you quit when things get hard. Now, let's move to the third number. 3. Because before compounding builds your wealth, there are 3 emotional phases that try to destroy it. And this is where most investors fail. Not because they don't understand the math, but because they don't understand themselves. And this is where everything either works or completely falls apart. Because investing isn't just numbers. It's psychology. And that's where most people lose. Phase 1. Doubt. This shows up early. Usually, in the first 2 or 3 years, you're doing everything right. You're investing consistently. You're staying disciplined. But when you check your account, it barely looks different. The growth feels invisible. And at the same time, you're watching other people around you making fast money in crypto, jumping in and out of trades, posting big wins online, and a question starts creeping in. Am I wasting my time? That's the moment people start second-guessing. They abandon the plan. Chase something more exciting, and unknowingly reset their entire compounding journey back to zero. Phase 2. Frustration. This one hits a little later, around year 3 or 4. By now, you've put in real money. Maybe $10,000, maybe $20,000, maybe more, and still, it doesn't feel like it's working. You expected exponential growth, but what you're seeing looks flat, slow, almost linear. And here's the truth. At this stage, it is linear. That's exactly how compounding works in the beginning. But most people don't understand that. They mistake slow progress for failure, so they pull the money out, spend it, redirect it, or throw it into something that feels like progress. And this is the most dangerous point of all, because the people who quit here are usually the closest to the breakthrough. Frustration isn't a warning sign. It's a signal. The engine is starting. Quitting now is like turning off the stove, right before the water starts to boil. Phase 3. Panic. This is inevitable. At some point, the market will crash. It always has. We saw it during the 2008 financial crisis. We saw it again during the COVID-19 market crash. And when it happens, it doesn't feel like a normal cycle. It feels like everything is breaking. Your portfolio drops fast, sometimes below what you've even invested. And in that moment, logic disappears. The smart move, stay invested, maybe even buy more, feels impossible. Because your brain isn't thinking long-term anymore. It's trying to protect you right now. But here's what history shows, over and over again. Every major crash has been followed by a recovery, no exceptions. The pattern is always the same. The 2008 financial crisis eventually recovered fully by 2013. The 2020 crash bounced back in just a few months. But here's the part most people miss. The people who sold during those crashes locked in their losses permanently, and the people who stayed invested, or kept buying through it, they didn't just recover, they pulled ahead. So how do you survive all 3 emotional phases we talked about? You don't rely on motivation. You don't rely on discipline. You rely on a system, because willpower always breaks under pressure. Systems don't. First, stop checking your portfolio every day. Seriously, the more you look at it, the more emotional you become. And emotion is what destroys long-term investing decisions. Checking it once a month, or even once a quarter, is more than enough. Second, automate everything you can. Set up automatic contributions so you're no longer deciding every month. Because once money is invested automatically, you stop reacting to the market, and instead of panicking when prices drop, you actually benefit from it. You buy more shares when they're cheaper. That's called dollar cost averaging. And it's one of the simplest, most powerful tools available to everyday investors. Third, track consistency, not just returns. In the early years, your real success metric isn't your portfolio value. It's your streak. How many months in a row you stayed invested. How consistent you were during uncertainty, because returns come later. But consistency is what creates returns in the first place. And finally, study what actually happened in past crashes. The dot-com bubble, the 2008 financial crisis, even the Black Monday, 1987. Every single time, the same story repeats. People panic. People sell. People assume this time is different. And every single time, the market recovers, because when you understand history, you stop seeing panic as a signal and start seeing it for what it really is, just emotion, not information. Now here's the final piece of the framework. 1%, one simple change. Increase your contributions by just 1% every year. That's it. And over time, that small adjustment creates a massive difference. Because wealth doesn't come from one big move. It comes from small, repeated upgrades. Let's make it real. If you invest $300 a month for 30 years at an 8% return, You end up with around $48,000. Now, increase your contributions by just 5% every year, and that number can grow to over $700,000 plus. Same investor, same market, different system. And that's the entire point of this video. Wealth isn't just about investing. It's about staying invested long enough and intelligently enough for compounding to actually work. Because the people who win in the long run are not the smartest. They're not the fastest. They're the ones who don't quit. If this changed the way you think about money, hit like, subscribe for more real finance breakdowns, and share this with someone who needs to hear it. And just a quick reminder, this is for educational purposes only, not financial advice. Your results depend on your decisions and consistency. I'll see you in the next one. And if even a small portion of that income growth gets reinvested back into your portfolio, you're no longer just letting compounding work. You're actively accelerating it. That's the real shift most people miss. Because according to the Charles Schwab study I mentioned earlier, even a 1% annual increase in contributions led to around 25% more wealth over 20 years. And when you scale that to something like a 5% annual increase over 30 years, you're not just improving results slightly, you're nearly doubling your outcome. And here's the part that makes this so powerful. You barely feel it. A 5% increase on $300 a month? That's just $15. Less than a couple of coffees. But, over decades, that invisible increase turns into hundreds of thousands of dollars. And this is where everything comes together. The 7, 5, 3, 1 rule isn't about doing one big thing right. It's about stacking 4 small advantages that work together. 7 years gives compounding enough time to actually matter. 5 categories protect you when markets get unpredictable. 3 emotional phases prepare you so you don't sabotage yourself. And 1 annual increase ensures your wealth keeps accelerating instead of slowing down. Let's make it real. Imagine someone starts investing at 28. She puts in $200 a month. After 5 years, she has around $14,000, and she feels stuck. It doesn't look like progress. It feels too slow. That's the exact moment most people quit. But instead, she changes the system. She commits to the full 7-year timeline. She restructures her portfolio using the 5-category approach. She prepares for the emotional phases instead of reacting to them. And she increases her contributions by just 5% a year, starting at $210. Small changes, no dramatic moves. By year 7, she's around $24,000. Not life-changing yet, but she stays in. By year 10, $42,000. By year 15, $89,000. By year 20, $156,000. And by year 30, over $500,000. But here's the most important part. In the last decade alone, she contributed less than $75,000 total, yet her portfolio grew by more than $300,000. That's the moment compounding stops feeling slow and starts becoming explosive. But none of that happens if she quits at year 5. That's the entire difference. Not intelligence, not timing. Staying in the game. So let's wrap this up clearly. The 8-4-3 rule fails in today's market for 3 reasons. It ignores real volatility. It lacks diversification structure, and it doesn't account for behavioral breakdowns. The 7-5-3-1 framework fixes all of that, not by predicting the market, but by building a system that survives it. Because in the end, wealth isn't about finding the perfect strategy. It's about not breaking your system before it has time to work. If this changed the way you think about investing, make sure to like the video, subscribe for more real finance breakdowns, and share it with someone who needs to hear it. And just a reminder, this content is for educational purposes only, not financial advice. Your results depend on your decisions and consistency. I'll see you in the next one. And it assumes flat contributions, which quietly leaves a massive amount of potential wealth untapped. That's exactly where the 7-5-3-1 rule comes in, because it doesn't try to predict the market. It builds a system that survives it. 7 years as your minimum commitment. Because historically, that's the threshold where the odds of a positive outcome become overwhelmingly strong across market cycles. 5 categories of diversification: broad market index funds, dividend-paying investments, small and mid-cap growth exposure, international markets, and defensive assets like bonds or cash equivalents. Because the goal isn't just growth, it's staying power. 3. Emotional phases: doubt, frustration, panic. Because the biggest threat to your portfolio isn't the market. It's how you react when the market moves against you. And finally, 1 annual increase in contributions. Just 5% more each year. Barely noticeable in your day-to-day life, but powerful enough to dramatically change your long-term outcome. Now, here's your simple action plan. Step 1. Commit to 7 years. Write it down. Treat it as a decision already made, not something you keep rethinking every year. Step 2. Build your portfolio using the 5-category structure. If you want a simpler path, a target date fund or a robo-advisor can handle this automatically. Step 3. Automate everything. Because once investing becomes automatic, it stops depending on emotion. And emotion is what destroys consistency. Step 4. Prepare for the emotional phases in advance. Write it out. What will you do when doubt hits? What will you do when your portfolio drops 30%? Because if you decide in advance, you don't panic in the moment, you just follow the plan. Step 5. Schedule your contribution increase. Put it on your calendar every single year. January works best. Even if it's just $10 or $20 more per month, do it consistently. Let time and compounding do the heavy lifting. Because wealth is not built in a year. It's not built in 5 years. It's built over decades of staying consistent when it would have been easier to quit. And the system you follow during those decades is what separates someone finishing with $300,000 from someone finishing with $750,000 on the same effort. And that difference isn't luck. It isn't timing. It's structure. The 7-5-3-1 rule is that structure. If you enjoyed this video, you'll definitely find the next one on screen even more valuable. And just a quick reminder, this content is for educational purposes only, not financial advice. Your results depend on your own decisions and consistency. I'll see you in the next one.